Today I would like to analyze Amazon, one of the largest e-commerce companies in the world. So here we can see the revenue streams, around 50% from the online stores, around 6% from the physical stores, and we also have the AWS, the cloud business from Amazon, with around 12%. So we can see in the stock price we are up around 51% in the 5-year charts, and we're going to take a look at the financials to find out if this company is a good buy right now. The first one we can recognize is a huge market capitalization of 1,913 billion US dollar. So this makes Amazon the largest e-commerce company by the market capitalization, and we do not have a dividend. So this company is still focusing on growth. Now we're going to take a look at the financials. The first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business, not a declining business. We can see here in 2020, the revenue was around 386 billion US dollar. This was a 37% increase from 2019, so very strong growth. Then in 2021, we had a 21% growth. This is very good as well. Then 2022, around 10% growth. Then 2023, around 12% growth. And in 2024, around 11% growth. So overall, what can we see? We have a good growth in the last 5 years, so it would be a check here. The next thing you're looking for is free cash flow growth in the last 5 years. The free cash flow is very important because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So we can see here in 2020, the free cash flow was around 26 billion US dollar. This was a 19% increase from 2019. Then in 2021, the free cash flow was in the negative around 15 billion US dollar. Then in 2022, the free cash flow was again negative in around 17 billion US dollar. And then 2023, it was positive around 32 billion US dollar. And then in 2024, it was again positive around 33 billion US dollar. So overall, what can we say? We had some good years and we had some good growth in the last 5 years, so it's a check here. But we also had some negative free cash flow in 2021 and also in 2022. Now we can also take a look at the operating cash flow, and we can see here only in 2021 we saw a decline around 30%, and we can see here in the other years we saw some good growth. And what we also can recognize is that in 2021 the capital expenditures increased significantly. So this is the main reason for the negative free cash flow in the some years, because we have the capital expenditures increasing. So this means the company investing more money in the business, maybe in new factories and new technologies. So actually it's something positive to see. The next thing we're looking for is a free cash flow yield over 4%. So this can also tell us about the valuation of this company. The higher the free cash flow yield, the higher the indication for undervaluation. So what we're going to do now, we're going to take the free cash flow from 2024. So this is around 33 billion US dollar. Then we're going to divide it with the current market capitalization of 1,913 billion US dollar. So the number we get is around 1.72. So this is not a great number to me. I think it's very low. It's under 4%, so it's not a check here. And I think it's not an indication that this company is undervalued. But of course, we also need to take a look at the future, because probably they can increase the free cash flow. So I think we should also make some assumptions for the future. If we ask ChatGPT, we can see here the free cash flow could be around 50 billion US dollar in 2025, around 75 billion US dollar in 2026, around 106 billion US dollar in 2027. So I think these numbers are a little bit exaggerated. Let's say in 2027 we can reach around 75 billion US dollar. So let's take this number here. Then we're going to divide it with the current market capitalization of 1,913. So then we would get the free cash flow yield for 2027. So the number we get is around 3.9%. So I think it's not a bad number, but it would be still under 4%. So I think this company doesn't look very undervalued right now. The next thing we're looking for is a debt to free cash flow ratio under 5. This means the company can pay back the debt with the free cash flow in under 5 years. A very important number, because if a company has too much debt and cannot repay the debt, it can risk to go bankrupt. So first we're going to take a look at the long-term debt. This is here around 60 billion US dollar. Then we're going to add the short-term debt. So we can see here and here, so around 5.5 billion US dollar. Then we're going to divide it with the current free cash flow. The current free cash flow around 33 billion US dollar. Then we're going to get the number we are looking for. So the number we get is around 1.98. This means in under 2 years we can repay the debt with the free cash flow. So the check here is a good number and we like to see that. We can also take a look at the cash on hand, how much money this company has in the bank, and we can see here around 101 billion US dollar. This is a great number and overall I think it's a great balance sheet. We like to see that. The next thing we're looking for is the enterprise valuation to free cash flow ratio under 25. So this can also tell us about the valuation of this company. The lower the number gets, the higher the indication for undervaluation. So we want to see a low number here. So first we're going to take the market capitalization of 1,913. We're going to add the debt. So the debt is around 65.5 billion. We're going to take minus the cash. So this is around 101 billion US dollar. And then we're going to get the enterprise valuation. So the number we get for the enterprise valuation is around 1,877.5. Then we're going to divide this number with the current free cash flow. This is around 33 billion. So this number we get is around 56.9. So this is quite a high number. So this is an indication that this company can be overvalued right now. I think we should also calculate the number for 2027. So we assume in 2027 the free cash flow could be around 75 billion US dollar. So then we're going to get a different number. So the number we get would be around 25. So I think if this company can continue to grow the free cash flow, the valuation right now could be okay. The next thing we're looking for is the shares outstanding decrease. This means the company buys back their own shares. We like to see that especially if we think the company is undervalued. So we're going to take a look here and we can see actually the shares outstanding did increase over the years. So this means the company puts more shares on the stock market to get the money. So this is something we don't really like to see, but I think is understandable because this company still wants to grow and wants to grow their business. They need more money. So I think this makes sense at this point. I would like to give my conclusion about this company, so let's start with a positive. So I think we had some good revenue growth in the last 5 years. We also had the free cash flow growth as well. In some years we had the negative free cash flow, so the main reason for that is the higher capital expenditures. This means the company investing more money into the business. I think we have a good balance sheet, which means a low amount of debt and a good amount of cash on hand. The free cash flow rate around 1.72% is quite low, which can be an indication for overvaluation. Then the enterprise valuation to free cash flow ratio around 56.9 is again indication that this company could be overvalued. Then in 2027, if we assume the free cash flow could be around 75 billion US dollar, the enterprise valuation to free cash flow ratio would be then around 25. So this company would be more fair valued. So I think this company can be a good buy right now if you believe that the free cash flow can grow significantly. So if you believe the free cash flow could be around 100 billion US dollar in 2027, so then this company would be a good buy right now. But if the free cash flow is lower than that in the future, I think this company can look overvalued. If you found this video helpful, don't forget to like and comment and subscribe for more content.